Hey there! Today, we're decoding the playbook of hedge funds. Let's explore some of the most common strategies they use to generate returns. First up, long-short equity. This strategy involves taking long positions in stocks expected to appreciate and short positions in those expected to decline. It's about betting on the relative performance of stocks rather than the market as a whole. Market-neutral strategy aims to eliminate market risk. By balancing long and short positions so that the portfolio is insulated from broad market movements, the focus is on the performance of individual securities, aiming for consistent returns regardless of market direction. Event-driven strategies capitalize on price movements caused by corporate events. This includes things like mergers and acquisitions, restructurings, spin-offs, or bankruptcies. The fund anticipates how these events will influence stock prices and positions accordingly. Global macro involves taking positions based on macroeconomic forecasts. Hedge funds might bet on currency movements, interest rates, or how countries' economic policies will affect asset prices worldwide. It's a broad strategy that looks at the bigger picture. These strategies aren't used in isolation. A hedge fund might combine these approaches or use variations like convertible arbitrage, where they exploit price differences between a company's convertible securities and its stock. The key is flexibility and the ability to adapt to changing market conditions. Each strategy has its own risk profile. Long-short can reduce market risk but not sector or stock-specific risk. Market-neutral might minimize market risk but can be complex to execute. Event-driven relies on accurate prediction of outcomes, while global macro might face geopolitical risks. Understanding these strategies is crucial for anyone interested in hedge funds. They show the diverse ways funds can seek profit. Check out the next video on the daily operations of a hedge fund.